All right, we're live. It is, what is it, October 7th, 2022, also known as Thanksgiving weekend
In Canada.
in Canada. Exactly.
Yeah.
That's a good distinction.
Yeah.
I was gonna wear my turkey suit for this episode, but it's in the laundry. It's in the wash.
Save it for the American Thanksgiving.
Yeah, exactly.
Mark your
Exactly.
calendars.
Exactly. Yeah, but big weekend, but hopefully I think last week we ended the week ended on an up, didn't it, on the market, or was it a down last week? Do you remember?
Last Friday, I think, was a up day as well.
Yeah, we were
Yeah.
excited last Friday. Yeah, yeah.
Yeah. Yeah. Yeah.
Well, let me just read the headline here, and then you can take it from there. Dow drops 600 points. Nasdaq closes 3% lower as rate pop after September jobs report. That came off funny, but you get the gist of it. What's
Yes.
so not as good news as last Friday.
Yeah. I mean, everyone wants to interpret the data one way or another, but jobs number came in at 263,000, I guess, new jobs, which was slightly better than expected, but 3 months of a continued deceleration for the people following the job numbers closely. I think that number, at least in the mind of many people that think jobs is the only number that controls what happens with the central bank, is that you probably need that number around 150,000, 150,000 for the central bank to feel like there's pressure in the employment market. So 263 today versus the 150 where you need to be. Market interprets that as hawkish data, which means that central bank continues with raising rates. So that's where we get a correction into today. To summarize it, PPI came in as well today, number, but generally the jobs number was the big one.
Hawkish opposed
Hawkish.
to dovish.
Doves. So the doves are making things easier,
Yeah.
cutting rates, quantitative easing. The hawks are tightening, making things more painful.
It's good to clarify.
Yep.
Okay. What else you got? What happened? Let's go back in time here. What happened this week?
Well, the for some people that watch CNBC, a big day today where there was an inverse Kramer ETF launched. So there's been a lot of press around Kramer and his results.
I like that. I like that.
So
I did not see
first
that.
day today, you could trade the inverse Kramer. So that's an interesting factoid.
Wow. Has
Yeah.
he responded to that? I gotta find him.
Uh yeah, I don't know if he's commented directly. He probably has. I just
Oh yeah.
that was interesting to see. As for what happened this week, generally more of the same from the perspective is everyone's following what's going to happen with rates. When do we change directions? Certainly in Canada at the end of this month, October 26th, I believe, is the next rate announcement. So all attention and time is focused on that. So we continue to watch that. As I said in the last couple of weeks, every day looking at the screen for new 52-week lows. I pulled up the 52-week highs just out of interest today. There's one stock on that list. And I think it's been trading for about 4 or 5 days. So on the other list, though, you get top from the top, you get Algonquin Power, Bank of Nova Scotia, CIBC, Brookfield, BMO, Rogers, CI, TransAlta, like all these big companies touching 52-week lows here today. So continue to watch and map that. As I've talked a few times, Bank of Nova Scotia is getting up to somewhere in the neighborhood of 6.5% dividend yield now. So these companies are starting to look quite attractive. And I think if your timeline's appropriate, you can look at them and say, yeah, I'm quite comfortable with where we go from here. But I'll cover a few slides which more about the housing market and rates and things like that. But there's lots to watch still, and the narrative though hasn't changed really. It's what's happening with rates, where's the central bank going, how much tighter can the financial system get before something breaks.
Gotcha. Okay. Well, speaking of the slides, do you want to jump right into those?
Sure, sounds good. Let's
What's
oh,
our number for today? How many
it's
slides are?
probably a bit longer than it should be.
Oh man,
Let me
classic,
know. I'm
classic.
going to
Is it because
share
it's a
the
long
screen.
weekend? Is it because it's a long weekend, so you had to get more in?
I felt like I needed to. I wanted to reuse a slide or two, so let me know when you can see that.
Yep, we're good.
Yeah, yeah. Okay, perfect. So it is, this is one that I've used multiple times. I'm not sure if I've used it all the time in the weekly, but I've been using it with clients and in the daily. I've put this out quite a few times, and I talk about the economy often, and the markets, and one of those difficult things is to differentiate between the two. And so I think this is a good visual to look at it as we think about, this is late bear market, and kind of this is also early recession above it. And so when we think about those two things, I've said the last, well, say maybe 6 8 weeks, I think we're in a recession. And we're only going to know that looking backwards. So as the best time to buy stocks is in the middle of a recession. And again, we only know that looking backwards. So right now markets and prices are telling us that we're in one, and so this is an important way to think about how things are going to play out for us.
Gotcha.
Mhm. All right. Okay, just got the one there. So this is really the big question about how high do they go, and this is Fed funds rates, and this is JP Morgan's research as of 4 or 5 days ago. So pretty current, just from a projection perspective. One of the things I'd like to point out really on to this slide is, I think there's this kind of preconceived notion, at least when the media looks at it, is you think there's this kind of long pathway of neutral rates, or at least that's how central bankers describe it. They say when we get to this level, we're just going to stay there for an extended period of time. But if we look at the last 20 years, and certainly if you scrape it back in history, go back another 40, 50 years, you get these kind of moments where, if you look at, this was 2000. I'm not sure how long we were here for. I'm going to say month, maybe 2 months max, before they had to cut aggressively. Again, as we get in 2008, this was slightly longer, but not maybe 6 months of rates here. And then again, once they start cutting right back down to lower low. And then as we got into, again, 18 to 20, again, we were briefly stuck here, and then rates got cut again. So, this is often, as we listen to Powell and Macklin speak, there's kind of this view that they're going to get to this neutral rate and then we're going to stay there for an extended period of time. I, I think it's not possible. I think they tighten too much and loosen too much, and as a result of that, they have to aggressively make decisions to change at some point. I'm not saying this is happening tomorrow by any means, but I do think when we reach that level, it's going to be a temporary level, and we're going to see the direction change, which results in maybe a slight pause and then a cut again.
Right.
Makes sense.
Yep, makes a lot of sense.
So a couple other things, just wages, as we talked a little bit on the outset there. There's been a lot of pressure up in wage growth, and so if we look at this, again, I think this is important to look back from a historical perspective. And one of the things that we're starting to see is wage growth is coming in and unemployment is rising. And so as these two things converge, these tend to be kind of that last signal that I believe the central bank is looking at right now. And so continue to watch this. But as these things start to converge more together, that's a bigger signal that we're getting to the end of this cycle.
Gotcha.
So a couple more slides, one on housing and this one on European energy. So as we follow what's happening in Europe, as I'm sure many people do, it's interesting just to see what the breakdown is. And Europe had been a really big leader in nuclear energy up until Fukushima, and now they've gone kind of completely the other way. And so if we look at like Germany, like they've had to crank up their output. This is coal. This is a big coal number here. And so as we think about all these countries and what they're going to do to be able to deal with these capacity constraints in the winter, they don't have a lot of room to turn it up. Where I was today looking at France tended to be a net exporter of energy to Italy. Looks like they're not going to have that same ability to do that coming into winter. So it's going to be important to see how this plays out. I thought this was an interesting slide just on a visual how that looks.
Gotcha.
Last two. So this is housing prices. So this was a capital economics report that came out today, just to give you a sense of where we are. I get lots of questions from clients around Canadian housing market, and we can certainly debate this around how low those levels go, how high rates go, because there's a lot of things that that we think about. But I thought this is an interesting way that they look at it. This is peak to trough expectations for prices. And so in Canada, capital X, we get a 20% correction in Canada, with the view that, well, we're approaching half of that done already. And so when we look at what that means to the rest of the world, U.S. itself hasn't seen the impact that Canada has just yet. And so I thought this was an interesting way just to look at it and think about it. But we'd certainly be further along the spectrum, I'd say, from as the Bank of Canada looks at what do we do. I'd say we're much more likely to the end of our raising cycle than the U.S. is at this point.
Okay. Great.
One more, last one.
Oh, I thought that was the last one. Okay.
This is the last one. So I talk about bonds a fair bit, and this is one of the things that we talked about maybe 3 or 4 months ago. But I thought we'd just bring it back around to think about what happens if rates do what. And so if we look at probably the top, we'll say the top group, these would be more connected to equity markets, but these would be the most sensitive to what happens in rates. And so if we look at in the US, for example, US Treasuries, if we see a 1% raise in US, 1% raise in rates, what does that do to the short-term bonds? So, you'd still gain about 2.4% if you're owning 2-year US Treasuries at this point. If you see a fall, if the US 2-year goes from 4% to 3%, you get a 6% capital appreciation in that backdrop. And so if we stretch that out to the 30-year bond, if we see the 30-year bond go from 375 to 275, that ends up being a result of 24% capital appreciation in those bonds. And so as I think about adding this into the portfolios, which I have been over the last many months, I think about the impact this has when things go in the other direction. When rates start falling, there's huge capital appreciation to be made in bonds.
Gotcha. Okay.
That was it for the slides today. Oh.
That was like a half marathon of slides right there. Not a full marathon. That's I've seen more. Okay, before we jump to what's going on, or the outlook, we got a question from Eric. Can you explain further what happened in the UK and whether similar situations are likely, example, with respect to US Treasuries?
Can do my best. So what happened in the UK is they talked about, well, Truss came out and said they were going to cut taxes, and the market interpreted that quite negatively. Pounds started selling off. A lot of the pension funds in the UK had leveraged positions on, and when we think a little bit about where they're doing that, these pensions are trying to gain income, let's say safe income, and bonds, at least gilts and treasuries and Canadian government bonds, provide you the ability to have the most amount of leverage. And so they would put huge leverage positions on because they're trying to generate yield. And so what happened is you had a run on the sterling, and then the pensions of the world started selling gilts to cover their margin calls. And so you had a run on bonds, you had a run on the currency, and if the UK central bank didn't intervene, a lot of these pensions would be in very difficult position and could have caused a systemic risk in the UK. And so that I believe has been dealt with at least now temporarily. Trust has said they're not going to proceed with the specific cuts that they originally planned to. They're still going to do some cuts, but not what they originally planned. But that's not really answering your question. Does that have similar risk in Canada and the US? I'd say that in the US, no. There wouldn't be the same amount of risk and exposure. If Biden came out and said we're going to cut taxes by 50%, maybe. I think that's a extremely low probability. If we had a material change in government and leadership in Canada, and then with a similar view that they do something like that, again, possible but quite unlikely. The pensions in Canada don't take on the same type of leverage and risk that they do in the UK. So it was a unique situation, but I think it shows you the fragility of the financial system. But I don't think there's the same risk in North America at this point.
Okay. Well, hopefully that answers your question, Eric. Okay. So what are we looking ahead to for next week? I guess the markets close. Canadian markets will be closed on Monday.
Yeah.
US markets open.
Yeah. So shortened week for Canada for sure. So we will be off, but watching the markets. If anything needs to be done, we'll take action. But I'd say coming into the close today, I saw a bunch of institutions kind of covering their short positions. So I'd expect you get some kind of rebound Monday, Tuesday. We'll see what happens. There's some, I think CPI comes out on Wednesday next week in the US. So that could cause markets to move a little bit. But things are pretty heavily oversold right now generally, and so I'd expect somewhat of a bounce. And particularly in Canada, we'd be waiting for the Bank of Canada at the end of this month, so I don't think there's too much data coming into Canada that could affect things. So we continue to watch that. I'd say the last thing that came out this week, which I didn't touch on, was a little bit Canada related, but OPEC had a meeting and they were reducing output. And so kind of the headline on OPEC was they're going to reduce 2 million barrels a day. They haven't been functioning at capacity anyways, so that 2 million barrel reduction was more like 1 million barrel reduction. So I don't think it's as dramatic as maybe the market interpreted it right away. But yeah, it's interesting to see that OPEC's reducing production when energy prices are low. So that's something to watch and think about, and probably keeps energy a little bit more elevated had they not done that.
Gotcha.
Hmm.
Okay. Yeah. Anything else you want to add before we let people go and get ready for their Thanksgiving?
Turkeys.
Get ready for get their turkeys ready.
Yeah. Yeah, no, I don't think so. I mean, lots we continue to watch and follow. As I say, stocks continue to come down, and we've been patient, waiting and watching, and we're starting to get into that zone where they look super attractive at this point. And as I've been telling clients this week, I think this is some of the best risk reward opportunities we've seen in 4 or 5 years. And so now it's a matter of being patient, waiting for the right opportunities before we execute.
Gotcha.
Yep.
Okay, well, I guess that's it for us. Hopefully everybody has a great Thanksgiving, and we'll see you next week.
Happy Thanksgiving. Thanks. Take care, everybody.
Bye now.
Bye.